more. We're joined by Carl Tannenbaum. He's the Executive Vice President and Chief Economist with Northern Trust and former Senior Vice President of the Chicago Fed. Carl, thanks so much for joining us this afternoon.
Glad to be with you.
So quite the reaction we're seeing across, various gauges, you could say, in terms of markets to not just the decision, but the statement, also the commentary coming from Fed Chair Jerome Powell. What jumped out to you the most?
Well, firstly, the material that we got from the Fed, their projections in the press conference, were encouraging in the sense that they're happy with the progress on inflation. But as the quote you just played illustrated, they're not entirely confident that inflation is going to get all the way down to the target level. The materials show that while inflation risks are better balanced, there's still a slight majority that think that the risks are on the upside. So as I looked at everything and listened, I did not get the sense that this was a group that was ready to start lowering interest rates anytime soon. And then I was watching the market reaction and noticed that the odds on a March reduction in interest rates had risen to more than 80%, almost as if they weren't paying attention to the same things that I was hearing. The market now has 6 interest rate cuts built into 2024, which is more than even the most dovish forecaster that contributed to the Fed's summary of economic projections. I've been watching the Fed and bond markets for a very long time. I cannot remember a bigger disconnect between one and the other. Oh,
that's really interesting. Yeah, it was interesting to see heading into it. There was the expectation when you're looking at markets of 4 cuts next year. And then you see in the dot plots, pointing to the possibility of 3. OK, so that's somewhat close. And then the fact that that made markets increase those expectations. How do you make sense of that?
Well, I don't know. I'm really waiting for my market sharpies to tell me what might be going on. Let me just add, Jacqueline, that the major economic news that we've gotten recently here in the United States suggests that the labor markets are still in very good condition, among the strongest that we've ever had. We do see slight softening in perhaps the job openings numbers, but the unemployment rate is well below its long-run average. In addition, we got consumer price index information earlier in the week. The categories that the Fed is watching most closely are the costs of shelter, rent and owner equivalent rent, which are grinding down only very slowly. We actually saw a tick up in services outside of shelter, as tight labor markets still seem to be driving the costs of some of the things, services that we buy upward. And they certainly seem to be cautionary tales, but the market seems to be sprinting ahead, notwithstanding those data points.
It was interesting to hear him talking about the fact that they had talked about dialing back interest rates. So they're having the conversation, even if it was just that we're going to be needing to have this conversation more over the next little while. But the concept as well that, they started with this idea of how fast they're going to have to raise interest rates. And then it became how high would they have to raise interest rates? And they're not still entirely sure on that front. But now, when do you start dialing back? And even just that language, in a way, is it really that much of a surprise to see markets sort of run with that? I mean, we're seeing equity markets also get quite the lift this afternoon.
Well, I think it's good news here in the United States, and hopefully it'll be the same for Canada and other countries, that the inflation picture is getting clearer and more benign. That would allow a gradual progression from where rates are today down to some neutral level. Right now, there's a big distance between the two. Here in the United States, from the Fed's projections today, there's well over 250 basis points of space there. And so if you look forward and say you want to be at neutral sometime, let's say in the next 12 to 18 months, that's a lot of distance to cover. And that's perhaps why the markets are assuming the Fed will have to get started quickly. On the other hand, you really do need to have that confidence that inflation is heading towards the targeted level, because removing the restriction could risk a reacceleration of inflation, which we have seen in our history in the past. And this crowd at the Fed does not want to be remembered as the ones that let the inflation genie out of the bottle.
Yeah, so when you're looking at, I mean, all of those factors that you've talked about, the economy, the labor market, the inflation situation in the U.S., when you're considering what that would mean if, if interest rates were cut too soon, what would that look like? When would be too soon, do you think?
Well, it's hard to say. My own forecast is that the Federal Reserve won't get the comfort that I think it will require to cut rates until late in the second quarter. So May might be my earliest possible cut based on the data that I'm seeing. Now, obviously, there are all kinds of things that could happen, but if you follow the Fed's forecasts, which are not that dissimilar from ours, you have a soft landing where growth is still reasonably good between 1.5% and 2%, which is right about our potential. And that is good enough probably to keep a certain amount of pressure on inflation and potentially hold it, let's say, at 3 instead of the targeted level at 2. So that kind of justifies a watch and wait game. Certainly the market does not seem to be watching and waiting.
Yeah, we're going to continue to watch the reaction on markets. Just one last question for you. In terms of the economy in the U.S., they were talking about, is the U.S. in a recession right now? And Powell was like, I don't really think the signs are pointing towards that at this point. But could it be over the next year? And he says, it's always a possibility that it could be a recession in the next year. But what do you think? Do you think that soft landing is going to be possible? It still sounds like a really tricky situation or a tricky idea of being able to make that soft landing.
Yeah, absolutely. The odds on a soft landing, though, today are much higher than they were a year ago. We were in that camp then, and we still are now. That is our base case. Certainly, there's a lot that could go wrong, either just misdiagnosis or mismanagement from the Fed or other policymakers. External events could certainly throw us off of that nice equilibrium. But today, it looks very likely that we're going to be able to bring growth down just enough to get inflation down without sacrificing too much in the way of higher unemployment. And if we can achieve that, the Fed, not to mention the markets and economists, are going to be very pleased with that outcome.
Carl,